All right. Already failed the test. Ready? Okay, thanks for having me, and thanks for putting together a excellent program again, with supplemented by excellent powder again, that we can't even dream of having more today. So I'll be sticking to Mark's theme of timing the discussion right. Hopefully a bit of a backdrop in terms of people having gotten maybe tired or forgotten about capital structure or general finance research. Might be useful to think about where we are coming from and how far we've gone in other areas for explaining capital structure issuance and buyback decisions or just general capital structure decisions, debt equity decisions. So it seems that the preponderance of papers, although Yuri was of course giving full disclosure of where the theory and the empirical work was done in terms of timing, the preponderance of work is done on trade-off theory and pecking order. And given the timing constraints, I refrain from promoting one of my most recent dynamic trade-off models with real frictions that Yuri always likes as well. That, for example, show we have strong persistence in capital structure over 20 years or more in the data that we can simulate. But so there's a lot of work apparently going on still in this area. And if you go with, say, Ivo Welch's wording, everything is kind of still a mystery. So good for academics. So I'm here and just saying, well, we continue, and no matter what we think about Yuri's paper, let's just accept it and move on and continue a healthy debate in terms of what we can understand in terms of capital structure. But clearly, empirically, we find it very challenging to get a very deep understanding of what managers do. While at the same time, this intuition of market timing is very compelling and very, very straightforward. You almost don't need a model. Well, the people we know who came up with the recent empirical implementation didn't write down a model, but got a lot of traction for that. And it's clear that if there's a mispricing, you would be tempted to say, well, the manager should take advantage of this overvaluation, sell shares, undervaluation, buyback shares, and that could maximize market value. And we have wonderful textbooks here that also confirm, in a simple example, we can get there. Now, in practice, and that's what we really, when we want to have an impact in finance, we want to have something to say about what happens in practice. And when you look at Fortune magazine or other business press recently, especially Apple is under got a lot of flack for their repurchase policy, and the pundits are estimating that up to $15 billion were lost in this repurchase program. And then you wonder really if the empiricist who says whether or not managers can time the market are really asking the right question. And that's where, so most of the empirical literature is looking at the whether question or the can question, and then Yuri, Ilona, and Panchung go back to saying, well, wait a second, under which conditions and whether they should really do this is very important. And they come up with a very rich set of results and surprising, thought-provoking set of results that I thought I should put on one slide, given Yuri was giving a slightly different emphasis in his talk. Of course, the first one was pretty clear. Conventional wisdom is a little bit challenged here. Market timing may not always benefit current shareholders. And the reason really is that there can be negative effects, on average negative effects, because firms might have very high share turnover. In those cases, and I'll try to give some intuition for that later, why this happens with a little example. Then what we kind of are familiar with overvaluation and undervaluation. So the negative effects might be larger for SEOs when you sell overvalued stocks, simply already because of the price effect. One of the three components we saw in his talk, price effect is always negative for the issuance announcement relative to the repurchase announcement. And then when you put everything together, it might be the case, depending on how much of value loss you get on the one side on issuance versus value loss or current shareholder value loss on repurchases, you might actually be better off. That's the most interesting result. Prefer a non-timing manager, a manager that doesn't do anything. So contribution, in my opinion, here. It's a clearly, and given my own research, a fundamentally important area in finance we need to understand more about. And you came up with a couple of theory papers, but I'm almost willing to say we don't have a complete treatment, a comprehensive treatment of equity market timing in one simple model that we all understand, which I think is given here with this canonical rational expectations equilibrium a la Grossman. And we get some new results. So what more can we ask for? Relatively low bar on the assumptions, low requirements in terms of not adding anything suspicious. and getting lots of new results. So I think it's intriguing work, thought-provoking research which we like, and especially when we're here, we like to discuss on the slopes again what happened in the morning. And so where some of this comes from is, in terms of changing our priors, is to carefully decompose the different effects that market timing has. So everyone is familiar, and the textbook treatment would probably say, well, we have this announcement effect, and that's great. Current shareholders benefit from the announcement effect if it's a repurchase. But we need to be more careful in terms of where mispricing takes place and what the adverse selection costs are of this announcement. And also, then there will be a tension, as I will show you in the example, hopefully, that the more turnover we have in a firm, the less of a chance we get to boost current shareholder value through the long-term capital gain, to long-term gain effect. So there's a trade-off, there's a simple substitution between one and the other effect that gets us new results, and that basically is almost assumption-free. It's the fact that we have a net that current shareholders are on average net sellers. I probably won't have time to talk about the empirics, but I laud them as well for the fact that they wanted to provide some evidence for one of the key assumptions in the data, that current shareholders are net sellers. So most of us like, and I personally like, to have a model that fits on one slide, and Yuri wanted to make it a bit more assumption-free and general what he presented, but it's really a rational expectations model with a normally distributed final price. And then to make it noisy, we have some non-timing firms with a fraction 1 minus lambda, and then a fraction lambda of timing firms where the manager is informed about the future payoff. And with this information, we'll then try to trade, either buy some shares back with a positive F, or sell some shares, issue more shares with a negative F, and follow a standard expected profit maximization policy in determining the F, or the main equilibrium in the paper, if you go to Appendix 1. And then what I think he spent a lot of time on, which is, in my opinion, also the crucial part here of the model, where when you understand that last bullet point, you probably also understand where most of the results might be coming from, is these demand functions. So we have an exogenously specified set of QIs for shareholders of normal, sort of non-normal turnover, and the QIs summed over the current shareholders will be negative, whereas, of course, with new shareholders M and current shareholders all together and no timing, they should, as he said, should sum up to 0. Now, what happens when the manager comes in? All of a sudden, there's an additional supply or demand of shares, and the way they've decided to do this, which I think is fairly reasonable, is to say that the new shareholders and the current shareholders kind of equally bear this additional supply or demand for shares, which is the Z function. So you could think of, say, the manager wanting to buy back some shares, and then the current shareholders were already selling some shares, but then they had to sell more shares because of they had to start selling more shares, whereas the new investors maybe also in a proportional amount buy into less shares. So that's kind of the adjustment coming from the Z function. What are the equilibrium properties? First, it's a noisy rational expectations equilibrium, so that therefore the informed manager can take advantage of the information and trade on his information, because the outsiders don't really know who they're trading with. The main mechanism I just tried to explain here with the Z function is that when shareholders are selling, the price will typically rise. When shareholders are selling more, the price will rise, because that's in case of a buyback. And when shareholders are selling less, that's when the price will fall. And that's where the problem comes with market clearing. That's where the new kind of, I have to skip maybe, that's where the new quantity effect really emerges. And the quantity effect is intuitively pinned down by the sum of these normal selling, the normal selling versus some cutoff here, Q bar, that's really determined by how we're sharing this additional supply or demand, this additional demand or activity, informed trading from the insider. So Yuri did a good job. I think I'm going to focus in these last couple of minutes on the example. There are these 3 effects. The first one is really the new one, and you can call it just an adverse selection effect. And you can, again, replace in the paper also this for the specific model they're using by the F and the equal sharing between new investors and new shareholders and current shareholders when the manager is trading. So everyone is really losing, but that's part of the person trading against someone who's informed. Price effect is asymmetric, so positive for repurchases and negative for issuances. And that's also giving you the intuition for why already It's even worse on average for current shareholders to have a manager time issuances, because there's one negative effect here, and then as we'll see now in the example in another, typically a negative effect here, which would have to be offset by the long-term gain effect when you hold the shares until the true value is realized. So how can we get more intuition about what's really going on and what maybe was missing in his talk, or was missing for some people, why this is not already in the literature? So suppose you have a firm with 200 shares outstanding, and current shareholders want to sell 600, and this cutoff, say if you have 100 new shareholders and 100 old shareholders, so equal proportions again, with 2,000 shares outstanding, the cutoff would be 1,000. True value, future value would be 100. Stock is undervalued, so we're trading at a 50, and the manager decides therefore to buy back 500 shares. I'm only focusing on the repurchase example because the issuance example will make it even easier to show negative net effects. So what the quantity effect then really says, we have 500 shares that somebody has to buy back, so the current shareholders have to increase their selling activity by 250. And in fact, each of the parties will have to make a compromise in terms of 250, but we're just focusing on the current shareholders. The same adverse selection cost will also apply to the new shareholders, which will scale down their, which will sell more in the buyback, will also scale down their buying activity. So quantity effect would be negative by the mispricing from 100 to the new to 100 to 55. To the new price, this will be the new price once we have the announcement. Then there will be an announcement effect for the 600 existing shares for the current shareholders of 3,000. And then finally a long-term gain effect, which basically comes from the remaining shares. We had 250 here, 600 here, and then we, after the buyback, have and another 250. So we have 1,150 as a fraction over 1,500 remaining shares outstanding on the total long-term gain of 1,750. So net effect will be positive now for the low turnover equilibrium. And what will happen now if we increase Q+, so if we increase this activity, all of a sudden here we have again for the buyback of 500 shares a requirement for equal sharing of 250 going up, but to 1,850. So what we now all of a sudden see here, there's a dilution, there's a big drop in the long-term gain, long-term gain effect, simply because there's much less long-term shareholders left because of the average high selling. The quantity effect is fairly similar, is identical, and we have a larger price effect because we have more shares, 1,600 shares going in there instead of just 600. And this is where we get a negative outcome. Why? So what is driving this? On the one hand, is the normal turnover has to be sufficiently high, but then in addition, when we have the sufficiently high turnover, you see here there's a relatively low weight on the mispricing component compared to here. So once we increase the mispricing or the adverse selection part, then this number could be even more negative as well. Last kind of observation is maybe really in the numerical example it becomes more transparent where the offsetting effect comes from, the quantity effect. And it could be attenuated, but you could argue because the current shareholders can only offer shares to the manager when he or she buys back, we can never really assume that this quantity effect completely goes away. So it might be, Yuri also suggested, there might be a different way to allocate, to specify the z function instead of equal sharing. Could be some kind of asymmetric sharing or something, but it's going to be always there, and the question is only how strong, how large these effects are. So I'm going to skip the empirical part, and I'm going to try to stick to the timing for hitting the powder and conclude incrementally important results. To my mind, very fairly advanced in terms of analysis and writing, intuitive as well. So if I would recommend it as a read, and I would be happy to recommend it also for publication if somebody asked me to do so for the JFC. Thank you.